Welcome, everyone. I am Mary Kane, President and CEO of the Maryland Chamber of Commerce. Thank you for joining us today for our 2023 legislative session recap. The 2023 legislative session marked a period of historic turnover across Maryland's political landscape. Along with many new faces in the General Assembly, Maryland also saw a new governor, comptroller, and attorney general engage in their very first legislative session since winning the 2022 election. And for the first time since the beginning of the COVID-19 pandemic, the House and Senate returned to their normal operations of conducting committee business in person. Thank goodness. It was a very active session. 2,275 bills were introduced in total, and the chamber closely tracked 139 pieces of legislation. From paid family leave, minimum wage, cannabis, broadband, and more, there were many important issues to monitor and to weigh in on. And with so many new faces making policy decisions that impact business, ensuring the voice of the business community was heard and understood was critical this session. I know many of you watching today are members and participate in our policy committees and our legislative committee. I just wanted to take a moment to say thank you, because collectively, our voice is incredibly powerful. When policymakers hear from our unified community of more than 6,800 businesses representing every industry in every corner of our diverse state, they gain an understanding of how important it is to develop and promote strong public policies that make Maryland better for business. And while we may not agree with every outcome from this session, we can be proud that our work did create greater understanding and affect change for all the legislation that we weighed in on. The outstanding work of our government affairs team, you know them, Andrew Griffin and Hannah Allen, have made such a success possible for the chamber. Their dedication, work ethic, and commitment to building bridges to support our business community is second to none. I also have to give a shout out to the rest of the team here at the chamber, because this doesn't happen without Michaela and Whitney and Teresa and Laura and Sawyer and everyone else here. We love them and they work so hard. Now, I look forward to seeing what they will continue to make possible through their advocacy on behalf of Maryland businesses, big and small. Now I'm going to turn it over to Andrew Griffin, our Senior Vice President of Government Affairs, who will walk us through the legislation from this year's session that will impact the business community. Andrew?
Thanks, Mary. Good morning, everyone. Like Mary mentioned, I'm Andrew Griffin, Senior Vice President of Government Affairs here at the Maryland Chamber. Myself, my teammate Hannah today are going to walk you through a lot of the big pieces of legislation, not necessarily always the past, but I think for items that we need to continue to look at moving into the future. And so you see here just generally the agenda we're going to walk through. First, I do want to highlight the process we use here at the chamber. It is very much a member-driven process. All of our positions are determined solely by the members. We don't take a position unless it is okayed kind of through our two-tiered process. And that goes for the chamber's legislative priorities as well. They are all completely member-driven. And so we have 10 policy committees here at the chamber. Of those policy committees, 4 of them meet on a weekly basis. The other 6 meet really as needed. That's certainly not a ranking of one being more important than the other. Those 4 that meet weekly just tend to share a larger workload than others. All of the recommendations that come from those policy committees that all of our members have the opportunity to join filter up to our legislative committee. And the legislative committee is really that group of individuals looking at our positions from a strategic standpoint and kind of giving that final stamp of approval and the okay that it makes sense for us from the cohesive statewide view to take a position, and then we execute it. So today, the way that we're going to walk through our legislation, it's going to be by policy committee and kind of that top line items, the top line items that we've seen. So we'll start off with cyber and tech. I kind of I hit on this already. We'll start off with the Cyber and Tech Policy Committee bills. One more slide. Okay, so here in cyber and tech, we have been, I think what's important is in Annapolis, we have seen for the last handful of years a focus on data privacy legislation. And here you see kind of 4 items that the chamber has been engaged with, not only this year, but in previous years. What is important here is this issue area is going to come to a head. You see kind of at each, and I will walk through these at each one, other than the spam calls bill, they did not pass this year, but I think in the near future, private industry is certainly going to have to, you need to plan to deal with the state beginning to regulate how you collect, store, and use data of customers, employees, and other items. And so I think that that's a really important overview. Here on this first bill, consumer protection, biometric data privacy. This is one we have seen for a handful of years, and the chamber has been very engaged with. The primary concern really from our view on this individual bill is dealing with what's called a private right of action. This is a legislation that has passed in other states, and it's been really problematic for the business community. Those of you who operate in multi-states are probably familiar with some of the fallout we've seen, particularly in Illinois, and what the impact of that has been on offering of products and services. And so the private right of action is really what has caused that issue. And so as we have seen this bill kind of go through the machinations the last several years, we kind of have remained steadfast in our opposition insofar as that component maintains as part of it. I will say, as I segue into the next bill, and I know for those of you that maybe don't operate in the data privacy space often, this can kind of be a little heady. As we look towards what the state's approach is going to be in data privacy, the chamber really is going to advocate for kind of a cohesive omnibus approach, one that is kind of in line with our neighbors in a more regional approach. And that way, again, many of you in the business community know it becomes very difficult to operate when you are offering products and services across state lines. When, let's say, Maryland has a certain way of regulating online, or the way that you may collect, store, and use people's individual data versus how maybe Delaware or Pennsylvania or Virginia may do the same. And so I think it's really important that we have a cohesive strategy moving forward. So I'll take that and segue into the next bill, Senate Bill 698, 807. This was really the first introduction that we've seen here in Annapolis of that omnibus data privacy. This bill was very much modeled after what has recently passed in Connecticut, The concern for us, you'll see here that we did oppose the bill. The concern for us is that the issue that we had in the previous bill, House Bill 39, I'm sorry, can we go back to cyber and tech? And in House Bill 33, excuse me, the biometrics bill was folded into this omnibus bill. And so that private right of action creating a lot of concern for the business community. We did oppose the bill. I think looking forward, we're going to be having a discussion about omnibus data privacy in the state and kind of hopefully moving in that direction as opposed to us passing bills piecemeal, year over year over year in taking that omnibus approach. On Senate Bill 844 and 901, this children's data, the source code bill, we did not take a hard position on this bill, but was modeled after a California legislation that has passed. It's currently being challenged in the courts. And so I think we did raise some concerns there. But certainly that bill, if you are maintaining websites or offering products for sale online, is going to be of concern. The last item I have here, I think is really important, certainly if you're doing business over the phone, and that is the spam calls bill, which did pass this year. What this bill did is it basically is restricting how certain types of phone solicitations can be made by restricting methods, times, and the type of information that people making these calls can use to identify their callers. There are a host. I do encourage you to look at this legislation if you're doing sales over the phone, if you're doing business transactions over the phone, it potentially could impact you. There are a host of exemptions built into the bill, obviously, and that's where we kind of weighed in and said, hey, we need to make some exemptions for really what are standard business operating procedures. Some of them I will highlight here. Things like an exemption for business to business sales, non-commercial solicitations for religious, charitable, political purposes, communications between a business and an existing customer or one that you may already have a contract with. Those are all exempted, and there are a host of others. But for those that are really just think of the spam kind of solicitation phone call that we all get, those are going to be less likely and probably aren't going to happen moving forward with the passage of this. All right, on the tax front, I think typically the chamber, we spend a ton of time on taxes, particularly the corporate tax environment. Rolling into this session, it's important to think the state's budget was in a healthy position. And so revenue raising policies weren't going to be ones that we spent a ton of time focusing on. At least that was not the impression we had. And that certainly isn't necessarily what played out. I think that story looking ahead is going to be a little different, right? The state had to do roughly a $500 million budget write down this year because of future revenue projections. And so whenever we get into kind of sticky situations, it is very common, unfortunately, when they turn around and are looking to raise revenue, the business community is usually at the top of that list. And so I think it's important to keep that in mind. To run down a couple of the top line items we did keep an eye on. The first, the House Bill 39, this bill came in one form and was heavily amended to a different form. It came in as a bill requiring corporations, when they file their corporate income taxes, to include an additional statement or an additional calculation on a, quote, effective corporate tax rate. There are a host of issues with that. First being not quite sure what that is. The second being, really what is the purpose of calculating the effective corporate tax rate? It doesn't really give you accurate information as to what the tax liability of a company is. And so with the concerns involved, the bill was amended to essentially become a reporting bill, which is the title that you see of the bill. Then currently, the bill essentially would have required the comptroller's office to issue an annual report calling for two different reports. One, a report of all the publicly traded corporations that operate in Maryland as well as other states. I think, a rational person would say that that's most publicly traded corporations. I think you'd be hard pressed to find one that only operates in a single state. But then a second report to accompany that number of publicly traded corporations, simply the list of the number of publicly traded corporations that don't have a Maryland corporate tax liability or quote, pay no Maryland corporate tax. And so when we think about that, we really just have these anonymous reports that don't provide a lot of helpful information, certainly not from a policymaking standpoint. So I think from our position, while we didn't take a position on the reporting bill because it didn't require anything of the business community, I think there certainly were concerns about what that information, would have been used for. And so that legislation did not pass, but I think it is something we've seen in the past and will probably likely continue to see in the name of transparency moving forward. The next bill, House Bill 46 and 576, should not be new to you if you were on this webinar, and it is combined reporting. It's an issue that we have dealt with here in Annapolis for 30 years. I think the fervor for combined reporting is commonly sold as a silver bullet for corporations who quote don't pay tax in Maryland. I think the interest in this comes around anytime the state needs revenue. They look at corporations preventing corporate profit shifting, and so combined reporting is part of that. This particularly impacts any company with doing business in multiple states. If you have a location in state A and a location in state B, it would certainly impact you. One that we will continue to work on. I think looking ahead next year to the 24 session, combined reporting is one that is likely going to get a lot of attention, particularly I would say in the House of Delegates. Moving on here to House Bill 551, and we do have a lot, so I do apologize if it seems as if we're kind of moving through this at a fast pace. We do have a lot of bills here, so I encourage you to drop your questions into the Q&A as you have them, and then we will leave some time at the end to address as many of them as we can. House Bill 551 and Senate Bill 547 was really a priority of the chamber, and this was seeking a sales and use tax exemption for certain telecommunications equipment. At the heart of the bill, that's what it was. And this was really the point of this is to speed up, as many of you know, rolling out broadband has been a top priority of the state and certainly in the business community since the COVID-19 pandemic. And this legislation simply was to make sure that every dollar available to rolling out broadband to Maryland citizens and to Maryland businesses was going just to that. And that was to making sure that it was being deployed on the ground. Unfortunately, it kind of fell victim to what I mentioned earlier, this $500 million budget write-down. Certainly, when you have to make budget cuts, sales tax exemptions are not going to be high on the list of items that passed. So this legislation was turned into a study really to look at the feasibility of doing this in the future. Hopefully, with some additional data, we can continue to push for that policy. And then finally is a great bill that I think many of you should be aware of, House Bill 707 and Senate Bill 660, which did pass, and we were very supportive of. This is coming out of was an initiative of the Comptroller's Office, and it was to create a taxpayer advocate division. And I think if you are particularly a small business, this is going to be very, very helpful. So many times we get questions here at the chamber from businesses about, I have a tax question, I'm not sure who to contact at the Comptroller's Office. I called them. They told me to call this person, who then told me to call this person. And so what this legislation is going to do is it's going to create an office, a taxpayer advocate division, which if you call and say, hey, I have a question about this or a complaint about this, whom do I contact? You're essentially going to be assigned a case manager. And that person is going to walk you through your when you call all the way to having your problem solved, they're going to walk you through the entire thing. And so I think as far as customer service goes, this is definitely and the comptroller has been focused on modernizing the comptroller's office. I think this is a great thing for the business community. I think it's a great thing really for the average Maryland taxpayer. So we're happy to be supportive. Okay, in the labor and employment space, and to be frank, we do a lot of work in the labor and employment area. And so this is probably the longest list of items here. So bear with me. The first, I'll start off with many of you, it's in the news. Most of you are kind of aware of what's going on here, but it's the Fair Wage Act, or the minimum wage bill. So Governor Moore came in and certainly made a top priority of his, raising or fast tracking the state's minimum wage to $15 an hour. Many of you are aware that we had a phase-in approach. And so the bill came in with some items we were really concerned about. The first of that being an attachment to the CPI, the Consumer Price Index, which ultimately would have led to the minimum wage increasing potentially year over year attached to the CPI measure. What ultimately passed, I think the bottom line for the minimum wage is the minimum wage is going to go to $15 an hour effective January 1 of 24. There is no attachment to CPI. And I think the other important factor is the phase-in approach that was pretty much negotiated in 19 that a lot of people were aware of, bifurcated businesses based on size. And so if you had less than 15 employees, you had a slower phase into the $15 minimum wage. And if you had 15 or more, you were phasing in at a faster rate. As a result of the legislation that passed this year, everyone, regardless of your size of business, the number of employees you have, is going to be jumping to that $15 an hour minimum wage on January 1 of this year. So there was no additional consideration given for the smaller businesses or those that are employing less than 15 people. On the paid leave front, House Bill 988, Senate Bill 828. Many of you are aware that last year Maryland passed a paid family and medical leave insurance program. It is a very big, broad sweeping program. Broadly, the program offers 12 weeks up to 24 weeks of leave for a very wide range of issues at partial pay. Essentially the premiums for that are shared by the employer. And so with the change in administration and really the need to address a lot of inconsistencies and unclear definitions passed in last year's legislation, there was a modification bill that came in this year looking to address some of that. We had initially opposed the bill for a variety of different reasons. I think thankfully some changes to the bill were made that we're very happy with, certainly from the view of the employer community. And so I think just to give you the highlights of what is passed, and this is, I would say, the top 3 items for you to know about the paid leave program moving forward, really as a result of what is passed this year. 1, the program has been delayed. So contributions were to begin October of this year. That has been pushed back to October of 2024. So that means the contribution that is to be paid by the employee and the employer is being pushed back to October of 2024. Benefits from the program. People cannot apply for benefits from the program until January of 2025. So the second item I think that's important on the contributions front, the legislation did put into the black and white of the law that the split or the share between the employee and the employer is going to be 50-50. The total rate of contribution, the other component, was capped at 1.2%, meaning it cannot be above 1.2% of the employee's wages. The Department of Labor still has to determine what that total contribution rate is going to be. They're going to have to look at a variety of different items, one being what is the need for the trust fund. And they do have to issue that contribution rate by October of this year. I think the expectation at this point is to be somewhere between the 0.8 and 0.9% range. So just to be clear, we're looking at 0.8 or 0.9% of employees' wages. That amount, which is the total contribution, will be split 50% by the employee, 50% by the employer. There is an exemption for employers with less than 15 employees. They do not have to contribute if they do not want to. And then I think the third big component here when we're talking about paid leave programs is how does this paid leave program interact with many of the other paid leave programs on the books, leave that employers may offer, and concurrence. There's a huge stacking issue there. We were able to address some of the stacking issues, but not all of them. And so what we're able to address in this year's bill is for employees who are FMLA eligible, and that's for employers with 50 or more employees, FMLA eligible in this program, if they were to decide to take FMLA, right, which you get 8 weeks unpaid leave for, and not apply for this program, that time would count against this program so that you wouldn't have someone taking 8 weeks unpaid FMLA and then getting 12 weeks of paid family and medical leave, Maryland family and medical leave insurance on top of that, for a total of 20 weeks potentially. So that was addressed. What is not addressed, and this is going to be an issue for small employers, is for employers who have individual buckets of leave, just one single bucket, you will not be able to make an employee take any of that leave concurrently. And so stacking will continue to be an issue there. There's a lot on paid leave. I will address some of the questions there, but that's the high level from this year's bill. Cannabis reform, I think what's really important here, there are a lot of questions on cannabis. From the Chamber's viewpoint, we were solely focused on maintaining employers' rights to ensure a safe workplace, a drug-free workplace for their employees and for their customers. I think the way that the legislation passed this year and is the intent of the General Assembly, and it is our understanding that things will continue to go on as they currently are. So if you utilize testing in your hiring practices, you're going to be able to do that. If you need to test as a requirement of, as an employment requirement, you're in a manufacturing facility, you're going to continue to be able to do that. You're going to be able to make, take employment action or reprimand someone as a result of drug testing. All of that is going to remain unchanged. That is the intent of the General Assembly. And so that is and has been our concern. We will continue to focus on it. I think as we move forward with adult use legalization, it's something we have to be really cognizant of as we see some of the issues popping up in surrounding jurisdictions. Washington, D.C. coming to mind, what's going on in New Jersey coming to mind. We will have to continue to be very vigilant. I will just quickly touch here on the right to this House Bill 17, what we kind of call the right to sit bill. This is not the first time we've seen it. It was narrowed to just retail establishments this year. I think we will continue to see this. We did oppose it. Listen, many employers already work with their employees to address these types of issues. Certainly for individuals that that need accommodation are typically covered under ADA and other federal laws. And so just an item that is really unnecessary, but I think we will continue to see it moving forward. And then Senate Bill 214 here, I will just highlight, this is probably the broadest attempt, the broadest expansion of harassment and intimidation in the workplace that we have seen. And just highlights, this bill did die. This was just the Senate bill introduction. We did oppose it, but just to give you an example of some of the items here that would have qualified as harassment or workplace or intimidation in the workplace, hiring incompetent subordinates, assigning unsuitable or offensive tasks, the assignment of excessive workload, taking credit for someone else's work. It's really a lot of subjective measures in the workplace would have been classified as harassment and intimidation. And, there are mandatory reporting requirements. And so I think we can continue to expect to see legislation pushing the envelope on what constitutes harassment and intimidation in the workplace. And then moving on here in labor and employment, again, we do so much work here. This wage range transparency bill, it did not move. It's not the first time we're seeing this. States continue to pass legislation like this. I think we can continue to see a push here in Maryland. It did not move this year in the House. There still remains concern from some businesses, certainly the requirements to post wage range transparencies and how that's viewed by out-of-state applicants, how it applies to remote positions, how does it apply to businesses who maybe don't advertise online or like the 7-Eleven across the street from me that has a posted help wanted sign just in the window. So there are concerns there. House Bill 349 and Senate Bill 345, Maryland Fair Scheduling Act. This has been introduced for many years. I will say that this issue seems to be losing steam. It is something that we will continue to oppose, though. Certainly for those of you that work in retail and restaurant industries, that is highly concerning. House Bill 1163, this is the first time that we saw this, and this is adding criminal record to an item that to basically what can be classified as discrimination. And so this is highly problematic in that it would have prevented employers from taking someone's criminal record into account when making hiring decisions. There were certain exemptions granted. For example, I think if certain federal and state laws required you to take criminal records into account, you could continue to do that. If you were an employer that provided programs, services, or direct care to minors or vulnerable adults, it did not apply. However, there are still a lot of instances beyond just those few exceptions in which someone may want to consider, criminal record during the hiring practice, right? They may be interacting with the public in a variety of reasons. And so it's something we're concerned about. The tipped wage bill did come back this year. It was kind of, I think maybe trying to piggyback off of the push for the increase in minimum wage. I will certainly kudos to the Restaurant Association of Maryland, who really did the heavy lifting on this and brought in a ton of people to speak against the elimination of the tipped wage exemption. And so I think that one was thoroughly put to bed. Finally, House Bill 1261 and Senate Bill 838, workplace fraud and prevailing wage violations. So this bill, I think is important, certainly for those of you dealing with in the contractor space. If an employer had knowingly either misclassified someone as an employee or contractor, vice versa, or knowingly violated the state prevailing wage law, this bill was adding up to $5,000 penalty, up to 60 days in jail for each offense. Could have applied to the manager, the business owner, a variety of people, in addition to being referred to the comptroller for a tax violation. And so really a big expansion of the penalties for violating workplace fraud or the Fraud and Prevailing Wage Act, as well as classification of employees. I think it's one we can expect to see come back. And certainly we did oppose this bill, and we'll continue to kind of stay on it. All right, I want to turn it over to my teammate Hannah here in a second, but just to kind of quickly wrap up in the healthcare space, some of the items that we did weigh in on, I think it's important for you all to be aware of. First, the Healthcare for Heroes Act. This was an administration bill I think we were very happy to support. This creates a grant program for reimbursing for healthcare premiums for individual or dependent coverage for certain members of the Maryland National Guard that are qualifying in either the TRICARE dental program or the TRICARE Reserve Select program. A fantastic piece of legislation. Similarly, House Bill 1148 and Senate Bill 582. This bill creates a commission on behavioral health care treatment and access to look at what is a comprehensive view or recommendation to the state on providing accessible, comprehensive behavioral health care to Maryland residents. And then the final one I will highlight here, this is kind of a crossover, both kind of healthcare policy as well as data privacy policy in the cyber and tech realm, as we talked about at the beginning. And there was an issue around health data and how private industry is collecting, using, storing that data. That bill was ultimately withdrawn, as it is likely, like I mentioned in the beginning, would be addressed in any kind of an omnibus data privacy bill that we may see, but something to continue to take a look at. So I'll turn it over to Hannah for the remaining couple issue areas, and then we will try to answer as many questions as we can.
Thanks, Andrew. Good morning, everyone. Thanks for joining us. I'm going to go over, I'll start with the Business Regulations and Operations Policy Committee. I'm just going to focus on 4 of the bigger bills that we focused on with this policy committee. So the first one I have here is the Antitrust Act. This legislation came from the Attorney General's office. It would have required any entity or individual who purchased over $8 million worth of assets or securities to give 60 days notice to the Attorney General prior to the purchase date. So this legislation would have been the first of its kind at the state level. Some of our bigger concerns with this was that it would have affected many different industries, like a real estate firm looking to purchase an asset, or a financial services firm, participating in a routine transaction, stuff like that. So it really would have hindered basic acts of commerce in Maryland. The threshold of 8 million is a lot lower than the federal filings threshold, which I think is 111 million. So it would tie up really standard and daily business investments and acquisitions of companies. And since the threshold's so low, it would really impact even the smallest of Maryland companies that participate, in acquisitions and investments. The bill does not or did not constitute any follow-up on behalf of the AG's office either. So, there's nothing expressed in the bill that said, after a business provides notification that the business could be given a guarantee that they'll show up to closing, knowing if their purchase is going to be halted and deemed as anti-competitive. That unknown would have really presented big issues at closing as well. So the chamber did participate in a call about this bill with the Attorney General's office. There were some other business representatives and stakeholders interested in this bill on the call as well. I think our concern and opposition was clearly expressed to the Attorney General's office. It would be very bad for business. It would raise, broad economic competitiveness questions. The bill did end up getting withdrawn by the sponsors after the hearings. Our new Attorney General has made very clear that he wants to gain more authority, which we did see this session through multiple pieces of legislation that his office introduced. So I do think this is something that we could see coming back, next year or in a future session, possibly in a different form, maybe with a higher threshold and other changes. But I do think this is something that we will see again and we'll have to focus on. All right, moving on to the child care providers bill. So one of the chamber's top priorities this session was increasing child care availability and incentivizing opening new child care facilities and expanding existing ones. The cost and availability of child care is a really big factor in someone's decision to return to the workforce. So we did support this bill, and this bill pretty much exempts child care centers or facilities located on a military base or federal property or certified by the DoD or Coast Guard from certain licensing and registration requirements for these providers. The legislation was amended to only apply to dependent children of military personnel, along with allowing the DoD, Coast Guard, or an installation commander of a base to assume responsibility for approving which children may be served by the child care homes. But really, the facilities outlined in the bill are already subject to really stringent standards to ensure safety of the children. So exempting these facilities from state requirements just encourages further access to childcare and promotes, returning to the workforce and also jobs for military spouses. So the House and Senate bills did pass out of their chambers. They did have unanimous support, and they are currently with the governor for signature. All right, next we'll talk about prompt payment requirement. So this bill was introduced last session. For the Senate bill did cross over to the opposite chamber, but we didn't see any movement in the House. So this bill establishes invoicing and prompt payment requirements for state grants. The state would have to make a payment under a grant agreement within 37 days after the due date in the agreement. It does also specify that any amount that remains unpaid after those amount of days will accrue interest at the rate of, I think it's 9% per year. I know last session, the General Assembly passed legislation to ensure that companies who were doing business with the state would get timely payments for their contracted services. So this bill pretty much does the same thing, but it applies to the nonprofit organizations that get grants from the state. Current law does stipulate that the state has to pay procurement contract invoices within 30 days of invoice receipt. And, there's currently no requirements pertaining to the timing of grant payments from the state. So, this bill really addresses that for these entities that rely on grants. Any delay in payment can jeopardize their ability to pay for their own expenses and complete work. I know the bill did have some technical amendments added, specifying that the comptroller has to make payment within 5 days after getting an invoice and not holding the comptroller liable to any interest. Of course, that would fall on the grant making entity. But we did support this effort to, really just hold the state accountable and to make sure that firms and nonprofits that are performing work are properly compensated in a timely manner. So the House and Senate bills did pass with unanimous support as well, and Governor Moore signed them into law on Monday. Right, the last bill under business regs we have here is price gouging. This is another AG bill. And as it was introduced before amendments, it prohibited a person during a state of emergency from selling an essential good or service. And these essential goods or services were outlined in the initial bill before it was amended. and it prohibited them from selling them for 10% or more of the highest price at which they made an actual sale of that good or service. So there were parameters around when it goes into effect and when it applies. So the 10% or more fluctuation in price would apply 60 days before the state of emergency is declared, 4 days before the state of emergency begins, and 90 days, I would say in effect for 90 days following the state of emergency. But I think the 90 days only applied to repair or reconstruction services. That's just used for emergency cleanup. The bill does also require the Secretary of State to establish an electronic notification system where someone can register to get notifications. And then once they receive them, it'll say when a state of emergency is declared. It'll list the categories of essential goods and services covered by the executive order. So it, allowed a person also who suffered an injury or loss due to price gouging to bring forth a private right of action, regardless of whether they're a consumer. So that was definitely very concerning to us. We were concerned over the fact that the bill listed out specific goods and services considered essential. During a state of emergency, as we've recently seen, flexibility and targeted enforcement is really important. So we did push to have that removed and just give the governor authority to create a list of essential goods and services. I think due to our concerns that we relayed to the General Assembly and other stakeholders as well, amendments were added that ended up removing the list of goods and services outlined in the bill, along with an increase in the percentage, which is now a 15% or more increase in price instead of the initial 10%. The governor will now be able to dictate what goods and services are deemed essential, depending on the circumstances, depending on the state of emergency. And then another big one was the right of action was also removed. So, I think the amendments definitely put the bill in a better position for the business community and employers. But overall, it does still put onus on businesses to prove that they didn't price gouge. So if the AG's office says, hey, we received complaints that you're price gouging, the AG's office doesn't have to prove that the business is in fact price gouging. So instead, the business has to prove that they aren't price gouging. So it just puts more work, compliance, record keeping, and onus on the business to prove that they aren't if there is a complaint issued. But both Senate and House bills did pass, and they were sent to the governor for his signature. All right, we can move on to energy and environment. 3 of the bigger bills that we focused on to highlight here. So just jumping in, the first one is the Clean Trucks Act. We did see this bill introduced last session. It did not have much movement. But this year's bill does require MDE to adopt regulations on or before December of this year that establishes requirements for the sale of new zero-emission medium and heavy-duty vehicles in the state. So it's pretty much directing MDE to adopt the Advanced Clean Trucks rule that comes out of California. So we did oppose this bill with the concern that zero-emission vehicles adoption is a very complex and costly process. You have to consider the chargers needed, the cost of the batteries, cooperation between manufacturers of both vehicles and chargers, energy providers, dealerships, and so much more that goes into all of it. But we were, also had some concern that companies who require these trucks will take their business out of state to jurisdictions that are able to order what they need. So there were several amendments that House Republicans introduced on the floor that did fail. But the bill was ultimately amended, and it now includes a needs assessment and deployment plan that's going to be conducted by a host of state agencies, and that is supposed to be due by December 1st of next year. And really, this plan or study will determine the feasibility of implementation with our current electric vehicle infrastructure, which is really important to take into account. It allows MDE as well to delay implementation of the regulations if it's determined from this assessment that it's not yet feasible. So the amendments did address most of our bigger concerns with the legislation. Given that Maryland is one of the states that did adopt California's emission standards, as some of you might know, we recently adopted, I think in March, California's Advanced Clean Cars 2 rule. I think the state would have adopted the Advanced Clean Trucks rule that comes from California either way, since MDE does not need legislation to move forward with the rule. But the legislation just provides more parameters and obviously a study which is needed that could be helpful to the department. So both bills did pass with the amendments, and they were signed into law by the governor last week. All right, we'll move on to the next bill, House Bill 915, Senate Bill 843. So this bill would have established the Climate Change Adaptation and Mitigation Payment Program in MDE. And really, this would serve to secure payments from businesses that derive revenue from fossil fuels or petroleum products. So the program would be used to fund climate change mitigation, infrastructure projects, address health concerns of climate change, and collect recovery payments on behalf of responsible parties. So the bill also does outline that the total liability would be divided by those responsible parties as well. A big thing to note about this bill is it is retroactive. It applies to any business engaged in the extraction or refinement of crude oil since January 1st of 2000, so a whole 23 years ago. It also imposed a potential liability of up to $9 billion on prior activities. So, it had many concerning factors, including the strict liability provisions, a big economic burden on domestic corporations, and then the long retroactive application window that would impose costs during a period when the company's actions was lawful. Businesses, we don't think businesses should be held liable because fossil fuels they extracted or refined were placed into the marketplace and used by a third party, especially again when it was so long ago. So, this was really, we saw it as a one industry bill with excessive fees. It was one segment, one segment of the economy should not bear these large and excessive costs. So neither bill ended up being brought up for a vote in their committees, so we did not see movement on this bill this year. All right, and then moving on to the building performance standards. So this bill would have required the Department of Labor to adopt new requirements as part of the Maryland Building Performance Standards, that new buildings meet all energy demands of the building without the use of fossil fuels. And it also added in there that they would have an electric ready standard for certain buildings that qualify for a waiver allowing fossil fuels. So that would be buildings like a hospital, a food establishment, things like that. So the bill would have enacted a pretty big change in Maryland's building performance standards. It would have banned usage of natural gas in new buildings. It would have reduced the availability of energy options for Maryland consumers and really created challenges for existing businesses and for any future development of these buildings. As many of you know, the PSC is mandated by the Climate Solutions Now Act, which passed last year, to complete various studies. I know there's the electric distribution system report and the general system planning study, and this would have gone into effect before the PSC could have completed these necessary studies. So, the chamber is supportive of responsibly reducing emissions, but we were really concerned about restricting the availability of affordable energy options and really just putting the state at an economic competitiveness disadvantage by phasing out affordable energy sources for these commercial buildings, for new buildings. Just had an unrealistic timeline, would have really drastically changed the permitting process. So this bill did not have a cross file. It was assigned to both the Environment and Transportation Committee and Economic Matters, and it did receive an unfavorable report from both. And that wraps up the Energy and Environment Policy Committee. Those were the, three of the bigger bills that we focused on this session. So we'll move on to the last committee that we have here to discuss, and that's our Workers' Compensation and Unemployment Insurance Committee. So two of the bigger bills here that we focused on. The first one is the Unemployment Insurance Modernization Act. So now I'll start with saying our Workers' Comp and UI Policy Committee was not as busy this session as we were in years prior, but the UI Modernization Act was a bigger bill that we knew we would see come in. We did meet with the bill sponsor before the start of session to discuss the legislation and what we thought would be introduced as a host of individual bills. Instead, it came in as an omnibus, all grouped together. So we did expect to see it. But really what this bill would have done is made 4 big changes to the state's UI program. It would have changed the taxable wage base that's used to determine employment contributions into the UI trust fund. It would have set new protocols for determining the maximum and minimum weekly benefit amounts. Another thing that it would have done is prevented the shifting of the table of rates to no more than 2 tables in a year. And and it required venture capitalist firms to post a surety bond to invest in Maryland companies. And then lastly, it would have extended the look back period in order to calculate an employer's experience rating. So really, these changes could have imposed increased costs on Maryland employers as a whole. The increase in employer contributions would have came during a time of high inflation, when we're just implementing our paid family leave program and accelerating the minimum wage. So first, we didn't think the timing was right with this legislation, but it would have also created a new collateral requirement for business investment in the state that would have placed us at a big disadvantage for businesses in other states when seeking venture capital funding. So just to kind of elaborate on that or give an example, if an angel investor invested in a company in Maryland, they'd be required to put in a surety bond to offset the cost impact to the uninsured trust fund. So let's say they cause layoffs, then the surety bond would offset that. And this would really just deter investment in Maryland businesses and would have been the first of its kind in the nation to do that. So that was a big concern to us. And, it was a big bill, and we didn't have issues with the entire bill, but there were some big pieces of it that stood out to the business community as a concern. So we do think that conversations with impacted parties and a review by the Joint Oversight Committee on Unemployment Insurance would be a much more appropriate way to address the different proposals in this legislation. Both the House and Senate bills were heard in Economic Matters and Finance Committees, and neither of them did receive a voting session. I don't necessarily think there was an appetite this year to take on such a complex and large bill, especially given the many new faces in the General Assembly and on these committees that this bill would have been in. But I do think that we will see this come back next year or in a future session, possibly in a different form. But we are expecting to focus on this as a priority for the chamber. So I think that's something we'll probably focus on in the interim and then be prepared for this upcoming session. All right, and the last bill we have to discuss today is a workers' compensation bill. This is the Fees for Legal Services bill, House Bill 1012. So this would have required the Workers' Comp Commission, if there's no compensation payable to a covered employee and the employee is awarded a medical benefit at a hearing, to order the employer or the uninsured employer's fund to pay a fee of no more than $2,000 for legal services on behalf of the employee. So the employer would be responsible for covering that employee's legal services. We did also see this introduced last session, but it did get an unfavorable report by Economic Matters. But workers' comp is really designed to provide balance between the interests of injured workers and the interests of employers by regulating the claims. So this bill would have placed the burden on employers by requiring them to cover the injured workers' cost to pursue their own claims, when the employer already has to cover their own cost of defense. I do think it's important to note that the cap and percentage for attorney's fees were raised and punitive fees were clarified in recent COMAR updates, which I think was in summer of 21. So we didn't feel that this legislation was really necessary, since the Workers' Comp Commission is best suited to regulate the award of attorney's fees in these cases. So currently, if indemnity benefits are not awarded, then fees are not paid by the injured worker. So the statute and regulations already provide a penalty for one party to pay the other's fees in case there's, something like objectionable behavior against one of the parties. So the legislation, including responsibility for payment of the injured workers' fees by the employer, is just unnecessary. But the bill was passed out of the House and it received a hearing in the Senate Finance Committee, but it was not brought up for a vote. But this is a bill we could see come back next year as well, or in a future session, possibly in a different form. But that is all I have for you all today. I'm going to turn it back over to Andrew. He will go ahead and open it up and take questions. Andrew?
Thanks, Hannah. Yeah, we'll go ahead and address some of the questions that we have so far. And if you have additional ones, please feel free to drop them in. I know it is, we try to cover a lot in an hour. And so we don't get to get in detail to everything that we may want to. So to hit a couple of these, a lot on the paid leave front. And so I will address kind of the paid leave questions now. The first, is there a wage cap for paid leave? Yes. Contributions, as well as benefits. The cap for that is the Social Security wage base. So 160, 200, I think is the current Social Security wage base, 160, somewhere around there. So there is a wage cap. So to clarify the stacking for paid time off for the Family Medical Leave Insurance Program. So the modification bill this year broke out the types of leave that employers offer broadly and said that certain types of leave can run concurrently. So if an employer they already offer some type of parental leave program or some type of a sick leave program, an employer can require that to run concurrently with family benefits. But they cannot require, let's say, paid vacation leave to run concurrently. So this is going to particularly impact small employers who, may be strapped in the amount of leave that they can offer. And so commonly what we see from the smallest businesses is they just offer one single bucket of leave. They just call it paid time off, right? And from that paid time off leave is what you use for any type of leave that you may need to take. Because of the classification of that leave as just general paid time off, the statute is not going to allow an employer to require that leave to run concurrently with the family benefit. And so an employee theoretically would be able to stack, let's say they get 2 weeks paid vacation, plus 4 weeks sick leave, plus, but it's all just rolled into one bucket and they just call paid time off. You use it as you need. They would be able to take that amount of leave in addition to whatever they may be getting under the family benefit. And so, there was a question asked, maybe the PTO bundles will have to be broken down. Yes, certainly for employers who are in a position to be able to do that. Typically, again, for small employers who are offering one bucket of leave, it's usually because there's a financial restraint there as to the amount of leave they can offer. And so that's why they're condensing it all into one set. And so breaking out all the different leaves that aren't required, right? The state requires sick and safe leave as well as some others, could be a challenge. It's also an administrative challenge, right? That, for a small business where maybe the business owner keeping track of all this, having, 4 or 5 buckets of leave may be difficult to manage. And so I think that is going to continue to be a challenge. And I think it's something it's a wrinkle we'll have to continue to work on and iron out moving forward. Let me look at a couple of the others. Just to clarify, there was a question about when the paid leave program went into effect. I mistakenly did say January of 25. Benefits can be drawn in January of 26. So contributions will begin in October of 24. And then benefits can be drawn in January of 26. Stacking salary cap. Question here about the 4-day pilot program work week. Why did it die? So the bill itself was withdrawn. It did not receive an unfavorable vote. The bill sponsors withdrew the bill. I think that they probably incurred a lot of resistance. We did not take a position on the bill, but I will say that whenever you're using taxpayer dollars for a pilot program, that piece of legislation came in that really, it didn't allow small businesses to participate. If you worked in certain industries where you simply couldn't go down to 4 days a week, and you couldn't condense your schedule, you were barred from participating. I know that is something I had heard from businesses about the way that it was introduced, and so it was withdrawn. I think that there were some issues kind of just with access to the pilot program that maybe were encountered. So there's more of a comment here. An employee makes $70,000 a year. How much would they be deducted from their paycheck for family, assuming 26 pay periods? I do not know the number off the top of my head. The Department of Labor released a report back in February of this year that produces some breakdown. I think what I have heard continuously, and I don't know that it is attached to a $70,000 a year wage range, but I think that they're saying they believe that the average deduction will be something like $5 or $6 a paycheck, $5 or $6 a paycheck. Is that correct, Hannah?
Yeah, so in the labor study that came out, they provided a chart on it that has different estimates based on the split, which now we know is 50-50. So if you were to use, I think the lower bound estimate was a 0.91% contribution rate. So just, we don't know yet what exactly the contribution rate the secretary will set. So that will depend on, that'll give you an exact amount, but assuming it's a 0.91% contribution rate, they used the weekly average salary of, I think it's 1,375 to kind of do that math. So the weekly cost for employers and employees based on that average salary of $1,375 would be $6.79 each. And that's per week. And that is based on a 0.91% contribution rate. But if you want to do the math, you could just divide that salary out to get a weekly amount and then multiply it. If you just want to use that lower bound estimate of 0.91, you would just multiply it by 0.0091 and then divide that by 2 because it's a 50-50 split. And that'll give you an idea of how much an employee would get taken out of their paycheck based on that $70,000 salary, if that's helpful. Not to get too mathy.
Thanks, Anna. So all employers have to participate in the paid leave program. So the requirement to be exempt from the paid leave program is that an employer must offer must offer benefits as good as what the state requires or greater. And so that means, you have to be offering at minimum the pay, the replacement rate, as well as the time off. So the 12 weeks plus the potential additional 12 weeks for a variety of reasons. So up to 24 weeks for all the varieties outlined in the bill. I will say that of state leave paid programs, ours is the most expansive as to what is covered. And so, yes, an employer can be exempted. They would have to submit their program to the Department of Labor, who has to approve your exemption. I can tell you that we have run into very few employers, certainly some of even the largest in the state, who are exempted from the program at this point. Many employers offer parental leave programs, but it's not for up to 24 weeks, or it may not be for all the reasons outlined in the bill. It may not be up to the replacement rate outlined in the bill. And that is a kind of a scheduled benefit rate based on income. And so I would encourage you to take a look at it. It's a very big program, but I can confidently say I think very few employers are going to find themselves being able to get exempted from the program. Now, I did mention this earlier, but smaller employers, less than 15 employees, are not required to give their contribution, their 50% of the contribution, but their employees are still covered in the program. Do I see an impact to the business community with the changeover of House Environment and Transportation Committee? Yeah, I think the loss of Chairman Barve is going to be a big one for the business community. He has always been a fair advocate, an open door for us, and has viewed things really down the middle. I cannot speak to Delegate Corman's how he's going to treat that quite yet, but obviously Chairman Barve had been there for many, many years and was certainly always open and willing to work with us. And so he will certainly be missed. And I think the last question I have here is, will the legislature recognize the need for a required graduation course on financial literacy? I do know this is something that Maryland Bankers has been working on for some time. A variety of other groups. We have not engaged too much on the program, or on that requirement. But I do know that there are some others out there. I cannot speak to it in any more detail beyond that. Last one. 15 or less employee, you stated the employer does not need to contribute to family plan. Will the employee need to contribute? Yes, they will have to contribute, but they will only have to contribute their share. So if the rate is 0.8%, that's shared 50-50 between employer and employee. The employee is still only contributing their half. They're not covering 100% of the cost. All right, let me just double check. All right, I think that is Maryland paid leave going into effect. I did mention this earlier, but one more time. Contributions will begin in October of 24, and benefits can be drawn in January of 26. So that does conclude. That's all the questions. I appreciate you all spending time with us today. We did run a few minutes over, and it is a lot to get in. At the end of this, everyone that registered will receive the recording as well as the slides. And of course, Hannah and myself are always open to questions. If you have additional ones, please don't hesitate to let us know. Other than that, thank you for joining us today. Enjoy the rest of your day.
Thank you.